This is shocking. I'm your host, Steve Van Metre, and thanks for joining me today. And our lead story today, Amazon's huge announcement has the industry in shock. I'll show you why Amazon's latest decision will affect the broad U.S. labor market in a way that nobody thought was possible. Plus, will a Fed rate cut be a boom for U.S. manufacturers? I'll show you why it won't. And speaking of the Fed, are they about to engineer the impossible with a rare soft landing? I'll show you one chart that will conclusively convince you that they won't. And we have a sponsor for today's show. We'd like to welcome Janover back to the show. You can find them on the NASDAQ under symbol JNVR. They're an AI-enabled platform for commercial real estate transactions. It's changing the industry, and they just launched a data service which is sending their stock higher. It just came out of a bottoming pattern, a setup we show you on our Sunday show and we share with our subscribers. It's so good that we think the stock could go up by as much as 60%. I'll show you the chart. Stay tuned to the end of the show or check out the pinned comment or description for more information. Now, let's head over to CNBC where we picked today's story up with a headline. It's Amazon tells employees it's time to return to the office 5 days a week. And this is all about the U.S. labor market. We've seen a massive transformation where there was a shortage of workers to now there's a surplus of workers. And this is something that every major company is going to be watching to see how Amazon's employees respond to this, because what it's going to do is cause a massive shift away from the hybrid work schedule, something we've warned about on the show was coming. Corporate employees will be expected to be in the office 5 days a week outside of extenuating circumstances unless they've been granted an exception. And before the pandemic, the CEO says it was not a given that folks could work remotely 2 days a week, and it will also be true moving forward. Our expectation is that people will be in the office, and this isn't just about a change in the U.S. labor market. This is also about the change in the economy and demand for retail sales. What Amazon is telling us is they're seeing these changes. They want their workers back, and what we're going to see now is the beginning of the end of the hybrid work schedule, something that a lot of U.S. workers don't want to see change. But the problem is, if they don't want to adopt it, well, companies are going to just say it's time for you to go. Because Amazon also plans to simplify its corporate structure by having fewer managers in order to, quote, remove layers and flatten organizations. And Amazon said each team will review their structure as part of the process, and it's possible they'll identify roles that are no longer required, and this is in a direct response to the change of the economy. And the belief that a couple Fed rate cuts are going to change things, Amazon sees it is not going to happen. They're putting an end to the hybrid work schedule, which means any employee who says, look, I don't want to go back to the office full time, you can better believe that their job is going to be one that's mysteriously going to come to an end. And this is why every major company is going to be watching Amazon, not only large companies, but even mid-sized companies, and they're going to see what happens, because if Amazon is successful at bringing everyone back to work, you can imagine a lot of companies are soon going to follow suit, because there's major changes coming, and Amazon wants to be ready to respond to them, and cutting headcount is just one. Because we looked at U.S. retail sales that came out today, and it posted a surprise gain. But if you think this is going to last, I'm going to show you why it won't. And this was boosted by online stores, which makes you think that companies like Amazon would want to retain workers. But they're seeing the light at the end of the tunnel is going dark. They actually realize that demand from U.S. consumers is falling, that they need to be more nimble and more responsive in order to maintain market share. The stronger than expected retail sales data for August suggests that, boosted by rapid wealth gains and falling energy prices, consumers continue to spend freely despite the labor market slowdown. But this is going to change in a big way in the coming months. And this is something that companies like Amazon see is happening, because there's issues that consumers cannot afford higher prices. We're seeing rises in delinquency rates, and the savings rate is near all-time lows. These are not catalysts for a booming economy. What these imply is the U.S. is heading to recession, and Amazon wants to be ready. The figures indicate resilient household demand midway through the third quarter, even as hiring and wage growth show signs of moderating. And that's one of the key points here, that Amazon realizes that they don't have to give out big pay raises, because there's going to be people that don't want to come back full time. They're going to head out the door, and this is just going to notify workers that the power shift has gone from the workers who were in short supply to now in companies who realize if you don't want to work, that's fine. We'll go out to the unemployment market market and will get someone to replace you right away. And as a result, don't look for big wage gains coming forward. And that's all a sign that demand is going to continue to fall. The report did little to sell the debate among economists of how much the Federal Reserve policymakers will lower interest rates on Wednesday, because there's this notion that the Fed cares about things like retail sales, industrial production, the manufacturing sector, and in some sense that they do, and they talk about it, but it doesn't go into making their policy decisions, because what they really care about is what the bond market tells them. And right now, the bond market is telling the Fed, you are way behind the curve and you need to cut, and aggressively. That's why we're likely to see a 50 basis point move here tomorrow. But we'll talk more about the Fed and their inability to stick a soft landing. Because let's talk about what Amazon is facing here and what they see in the data as we look at advanced retail sales. Now, this is inflation adjusted or real retail sales, that in blue, against total income or average hourly earnings multiplied by average weekly hours of production of non-supervisory employees. And what we see is that slowdowns in total income lead to a decline in total spending in terms of retail sales. And it makes perfect sense, because as prices rise against slowing income, consumers just don't have as much money to spend on the discretionary side of the economy, and naturally it leads to a decline in retail sales, which is going to impact companies like Amazon in a big way. And in fact, we can see this relationship heading into the dot-com bubble, again in the global financial crisis, where once again you see a decline in incomes lead to a decline in retail sales. It happened going into what was going to be a double dip recession around 2012, but the economy pulled out of it. And look where we're at now. You see inflation adjusted retail sales are still negative. They've had barely ever crossed over the positive line here since 2022, and this is squeezing retailers at the margin at a time when everybody acknowledges that demand from workers is going down, and that means hours worked is falling, that means wage gains are slowing, and that means less money for consumers to spend in the economy. And of course, that means that all these companies, they need to make adjustments if they're going to maintain their profitability, and that all comes back to the labor market. Bring people back into the office full time. If you don't want to come, you're gone. And in fact, even if you do, well, not all of you might have a job. In addition to cooler job growth, economists forecast a combination of elevated borrowing costs, but this is a big one, the depletion of pandemic savings and higher cost of living will eventually prompt American consumers to cut back. And that is the big fear. And that's what Amazon sees coming, that consumers don't have as much money, the cost of goods is still too high relative to their income, and there's going to be a major shift in spending. They want to get ahead of that. I think it's coming in the next couple months as we head into the holiday season. What do you think? Weigh in the comments below. But let's talk about our sponsor of the show, Janover. I want to show you their 10-day chart. Now, you can find them on the NASDAQ under the symbol JNVR. We've got the volume profile line drawn in here, and what you can see is when the price of the stock is trading above a volume profile, that suggests it's about to take off. We think it could go up as much as 60%. I'll make the case later at the end of the show. Stay tuned for that. But let's continue talking about what's going on at Amazon and the broad U.S. economy, because we look at advanced retail sales, again, inflation adjusted in blue, but against the consumer price index. And something we see heading into slowdowns is the fact that the consumer price index is actually relatively high compared to what you see in retail sales. And what this is saying is that consumers can't afford higher prices, and that's why you see that real retail sales declines. You see that happen here again, going into the dot-com bubble and then into the global financial crisis with a brief instance around 2006. And after that, it looks fairly good. But how about right now? What do you see? The consumer price index is telling retailers that prices are still too high. They're going to have to cut prices because consumers can't afford them. The problem is businesses don't have the margin. Their expenses are too high. So how do you deal with that? Well, you send workers to the unemployment line. That's what Amazon's doing, flattening their structure, looking to get rid of people. And don't be surprised by the end of the first quarter next year that Amazon's footprint in terms of employment is smaller than it is now. But let's talk about the personal savings rate, because we know there's going to be a shift in spending. We just don't know when it's going to happen, but we believe it's coming soon. I think, again, over the holiday season, we're going to see a lot of companies miss their targets. And this is why the earnings season here is going to be critical, because we're going to get an update from CEOs on spending habits. But let's take a look at real retail sales again, now against the personal savings rate, because when you see consumers decide to start saving, well, what you see is the decline in retail sales. And this is important because you see this relationship happen over and over. And right now, retail sales are still inflation adjusted to the negative side. And that's a problem, because when we look at personal savings, it's still near its all-time lows. At some point, consumers are going to start prioritizing savings, and that's going to send real retail sales plunging. This is dangerous news for retailers, wholesalers, and manufacturers, all which will be forced to lay off. And the details suggest consumers have grown more frugal, going online to search for deals and discounts on essentials and back-to-school items. And this is something we've seen in the data from companies like Dollar Tree and Dollar General. They've been saying foot traffic is up, but sales aren't matching what's happening. Consumers are going in, they're looking for what they need, they're looking for a discount. If they don't find it, they leave and come back later. But as we started the show, will rate cuts be a boom for U.S. manufacturers? Well, about to show you, there's not a chance it's going to work at all. As U.S. industrial production rebounds after a hurricane-related drop, but that's only because numbers start to be revised lower. Here you can see a 0.8% increase in production in factories, which surged higher as mines and utilities followed a downwardly revised 0.9% decline a month earlier, once again putting into question the validity of U.S. data. What good is this 0.8% increase if we know it's likely to be substantially revised lower in the months to come? But for now, the headline number looks good. Manufacturing production rose 0.9%, while mining and energy extraction increased. Output at utilities was unchanged in August. This all coming after the hurricane in Texas did shut down parts of the economy. Now it's back online. Everything looks good, but all until we see the next downward revision. And despite the pickup in factory output, manufacturing remains lackluster as high borrowing costs restrain capital spending and limit consumer demand for big-ticket items. It's nothing to do with high interest rates here, because manufacturers are seeing their inventory start to build up now. Their new order books are shrinking, their backlogs are going away, and things are not moving. So why would they need to invest in capital improvements? There's no reason for that, because there isn't demand. Export demand remains subdued as well, but Fed officials on Wednesday are seen taking the first step in easing monetary policy as inflationary pressures subside. Many who believe this is going to be a huge boom for U.S. manufacturers, the data suggests otherwise. As we now look at industrial production in blue, shown on a year-over-year rate of change against the federal funds rate in red, and you can see declines in the fund rate lead to industrial production slowing and even contracting when it goes through that horizontal black line. We can see that happen again at the dot-com bubble, both headed lower, once again at the global financial crisis leading into the pandemic. And now the belief is if the Fed cuts, everything's going to get better. But history says it's highly unlikely that's the case. But there is some signs inflation might pick up as capacity utilization at factories, a measure of potential output being used, rose to 77.2% from 76.6%. The overall industrial utilization rate increased to 78%, which is actually very interesting here because the survey data that we've been seeing suggests otherwise. The question is, though, does inflation actually lead capacity utilization? Well, it does, but it didn't always used to. We go back here in the 1970s and even the 80s, where we see capacity utilization head down, and that leads to a decline in inflation. As we move now more into our modern economy, we see inflation start to slow down, roll over, and then decline. And that leads, of course, to less demand, less need from factories, and you see capacity utilization follow. Now, despite a recent uptick in capacity utilization, the Consumer Price Index is saying not a chance. Demand is plummeting, and so too will factory utilization, which means, of course, companies will be forced to lay off factory workers, cut more hours. They're going to follow all the same path as we're seeing with Amazon, as the broad-based slowdown of the U.S. economy affects everybody. But will the Fed be able to nail the mythical soft landing, something that is so very rare that only a few people believe they've actually done it? Well, the answer is no. As markets hinge on Powell emulating Greenspan to avoid a recession. Now, this headline is quite fascinating because even Alan Greenspan said afterwards that he doesn't think he had anything to do with what was deemed a soft landing. And nearly 3 decades ago, bonds and stocks are rallying ahead of a critical Fed meeting, but this time the central question for Chair Jerome Powell is which approach, reducing rates by 25 or 50 basis points, which is most beneficial for the U.S. economy. Now, we made the case in yesterday's show why the Fed's going 50. There's no choice about this. They have to. But the view that the Fed can do what Alan Greenspan did, again, it all comes back to after the fact that Alan Greenspan said he didn't think he had any impact on the economy and that cutting rates made absolutely no difference. I'll show you a chart here in a moment. Here we see the chief global market strategist at Invesco said the U.S. economy looks set to avert a recession as the Fed starts easing policy just ahead of the U.S. election. And this is not a surprise coming out of the financial services industry that needs to sell people stocks. They want people to buy stocks. And no matter what the data says, they're going to tell you there's a good chance we're going to avoid a recession. But yet history shows with nearly 100% certainty when the Fed starts cutting, well, we're headed right into a recession, and that's never good for stocks. Once the Fed starts to cut, there'll be a psychological reaction to that. She said that will be supportive, and yes, it usually does bring money into the markets. The problem is what we're going to see is the U.S. economy continue to slow. That's going to be very bearish for stocks. It's highly likely we could be at the very beginning phases now of what could be the next bear market. But let's talk about that one chart that says the Fed's got no chance of nailing the soft landing. We go back to 1995 when everyone said we achieved a soft landing. But what happened? The Fed cut rates just a little bit, somewhere from roughly around 6% to about 5.5%. This was the economy under then Fed Chair Alan Greenspan's watch. But what really happened, because he did say he didn't think it had any effect and that he had no real power over the economy, is you look at income growth surged during that time. That's what really fixed the economy. Look at right now, you do not see hours worked rising. You do not see big pay raises. You see just the opposite. In fact, we go back to each and every recession, and what do we see? A slowdown in total income means that we are not going to see a soft landing. We're absolutely going to be headed into another recession. But this doesn't stop investors, because this is what they're looking at as the S&P has rallied an average 13% in the 6 months after the central bank started cutting, except for the years of 2001 and 2007, meaning investors are going to be piling into stocks on news like that. Short-term treasuries, meantime, have usually outperformed their longer-term notes, a phenomenon known as yield curve steepening, which happens during Fed easing cycles. 6 months after the first cut, the 10 and 2-year yield gap often widened by an average of 44 basis points, except, as you can imagine, when we're headed into recession. But if you're looking for opportunities in the market, look no further than the stock for our sponsor today's show, Janover. You can find them on the NASDAQ under symbol JNVR, and all the information you need is in the pinned comment and description. But let's talk about what's going on at Janover, because they're an AI-enabled platform that powers faster, smarter commercial transactions. Our suite of commercial real estate, small business, and lender products makes sourcing, evaluating, and closing the right opportunities frictionless, driving better outcomes for all. From solopreneurs to large institutions, we're revolutionizing the way deals get done. And they're doing that in an industry that's ripe for digital transformation, as we see technology has radically transformed consumer finance, but commercial transactions have been left behind. And what you see is the commercial real estate and business owners on one side, financial institutions on the other. And what we're seeing is Janover bridge the gap, as all sides of the transaction are missing out on perfect opportunities that never come across their desk. But that now is changing, because they launched in 2019 with a platform for commercial loans, and this is bringing borrowers and lenders together with a marketplace that's connecting the CRE and business borrowers with lenders. They get matched with the best loan terms from over 2,500 lenders in minutes, not days. They get expert guidance, a fast process, and easy-to-use portal. And Janover makes money by taking a fee every time a loan closes. and they're building a world-class AI-first firm in 2024. They've got over 200 billion of commercial loan applications, with 40 billion in the last 12 months, over 100,000 all-time borrower applicants, over 2,500 lenders on their platform, and 600 million in closed transactions. They are the #1 destination for CRE loan education. Let's talk about some statistics, because we believe that this is going to surge higher. One of the key things we look for is debt, and they've got none of it, $0 in long-term debt. That is as of September 30th of 2023. But let's talk about some of their latest news here, as Janover's groundbreaker platform achieves over 100% sequential monthly increase in operating margins in June of 2024, achieves record profitability for the second consecutive month. Janover, which acquired Groundbreaker in November of 2023, reports that this new business line achieved profitability for the second consecutive month of June 2024 since the acquisition, reflecting a sequential monthly increase in operating margins by more than 100%, increasing from approximately 30 to 64%. Blake Janover, the CEO, said, "We're delighted with Groundbreaker's performance. Since the acquisition, the integration has gone better than expected, and the credit is due entirely to our collective team. As the business line achieved profitability for the second consecutive month, and the future looks bright. Our plan for Groundbreaker is to remain profitable and deliver healthy cash flow throughout the remainder of the year." And Janover launched Janover Pro, game-changing subscription access to commercial lending data and more. And I think this is going to be huge for the company, and the stock is starting to validate that, as the company announced the launch of Janover Pro, an innovative subscription-based service that provides user access to rich and dynamic data set of commercial lenders through Janover's user interface. And Blake Janover, the CEO, said that Janover Pro is a game changer. "We're democratizing the data that separated institutional debt shops from mom and pops and the small multifamily and commercial property operators from the biggest players. Although it's currently in its infancy, we envision creating a platform akin to CoStar for commercial loan origination. This fits squarely inside our box of migrating to subscription revenue and provides the deepest value we can to our clients. Our aim is to become the name that people trust in our industry for forward-thinking solutions that drive real value. It also allows us to continue to provide the high-touch, bespoke service that we've become known for on the capital market side. We think this addition fits like a glove, and the market is agreeing with it." As Janover Pro is another exciting milestone in our journey to operating primarily as a software as a service recurring revenue business. This is only the beginning as we continually innovate and expand Janover Pro's functionality to better serve our customer needs. Future updates will include features that our internal team is already successfully using, such as the ability to create and share professional offering memorandums directly with lenders through the platform, advanced deal shopping, and more. Now let's talk about the chart setup here, which is rather impressive. You see this bottoming pattern here. We showed you that 10-day chart, and we'll look at that again, but the stock came down, and on the news that they're offering Janover Pro, you see this big shift as buyers start to step in here. Now you see up here right around 83 cents. This is the volume profile over the last 6 months, which implies that buyers are now coming in underneath, but this is where the sellers are at, is above that red line, suggesting that the next major move for Janover is to head right back up to that red line. Again, you can find them on the NASDAQ under the symbol JNVR. And as we zoom in now to the 30-day chart, what do you see? The volume profile line here. This is the next level of resistance. If the stock can break through this, look for a lot of upside potential, because as we zoom in, you get this very clear picture of this bottom here as support came in and buyers stepped in to buy the stock, and now it's breaking out. You can see it very conclusively on the 10-day chart, where you see the 10-day volume profile indicating that over the last 10 days, buyers have been coming in here. You can see the volume stepping in. This is driving the stock higher, which we think has the potential to go up as much as 60% when it retraces back up to that volume profile line at the 83-cent level. But as always, with any company we feature on our show, you're under no obligation to purchase their stock. Be sure to do your own research before placing any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.